Hello. Today in less than 5 minutes, K&G International Advisors will give you a summary of last week's most important international financial news, focusing on debunking false narratives and specifically talking about how inflation is Putin's fault. This week, the false narrative we want to challenge is on the topic of inflation. It's hard to miss this issue, which is now increasingly becoming a part of everyone's daily life, as well as impacting investment markets significantly. After remaining largely dominant in the developed world for the past 30 years, inflation has very quickly risen to its highest level since the 1980s, taking governments, central banks, and everyday consumers by surprise. Large sections of populations in the developed world now face a cost of living crisis as their incomes are not keeping up with inflation in energy, food, and other living expenses. The situation facing those on medium and lower income in the developing world is even worse, with the real risk that many will not be able to afford food and other basic necessities. High inflation is bad news for everybody. Understanding the causes of the current inflation is therefore very important. Misunderstanding these causes is risky, as we may enact the wrong policies in response, exacerbating the problem. The stakes are very high. This brings us to our third false narrative, which we think is critical to debunk given the immediate threat to the livelihoods and lives possessed by the current inflation. This false narrative goes something like this. Russia's unprovoked invasion of Ukraine is the primary cause of high inflation today. Both countries are major commodity exporters, especially so in the case of energy and food. As the war continues to interrupt the supply of these commodities, the global market, prices have been pushed up and will remain elevated until the end of the war. Given that this war is ultimately the responsibility of one man, Vladimir Putin, and this obscene ideology, and the war has caused the inflation, then ultimately this inflation is his fault. If only he hadn't invaded Ukraine, inflation would still be low and stable, and we could continue with our lives. It follows, therefore, that if the war ends, inflation will also come down significantly and potentially stop being a problem. The narrative is wrong, plain and simple. The Biden administration's unshamed parroting of this narrative for political gain is to be kind, outrageous, and symptomatic of a president that has lurched from one crisis to another without ever taking responsibility. But this is a discussion for another day. The task at hand is to understand where current high levels of inflation come from. Was it Putin's fault? Well, let's look at the numbers. Inflation levels had remained at or very close to 1 to 2% in the US and Europe for 30 years leading up to the 2020 pandemic. Many economists, political leaders, and leaders with central banks concluded that low inflation was now a permanent fixture of the modern economy. But this started to change in 2021. U.S. inflation rates jumped over 4% in April 2021, the highest reading since 2008, and inflation kept rising, well above 5% in July 2021, north of 6% by October, hitting 7% by the end of the year, the highest reading in 30 years. Russia's full-scale invasion of Ukraine started in February 2022. Inflation was already hitting its highest levels in decades before the invasion started. Yes, inflation rates have continued to climb since, moving above 9% in June with this year. And yes, higher foods and energy prices as a result of the war are almost certainly a contributory factor to the current inflation levels. But, and this is a critical point, the war was not the cause of high inflation. We already had a serious and growing inflation problem before the war started. All the war has done is exacerbate a pre-existing inflation. The war ending, therefore, doesn't necessarily solve the underlying inflation problem. What then caused this inflation cycle, the worst since the 1970s to the 1980s? In response to the pandemic, the world's central banks printed a lot of money. Money printing, historically at least, has been inflationary. Close to 30% of the dollars in circulation today in the global financial system were printed in the last 2 years. It's not coincidence, we would argue, that many of the 2-year inflationary numbers for assets like housing or even personal consumption goods like cars or eating out have seen prices rise by about 30%. All of that new money had to find somewhere to go. Then, with the economic recovery from the COVID pandemic already well underway last year, labor markets in the developed world very quickly moved close to full employment. labor shortages were already becoming a problem in some sectors of the country early last year. Into this hot economy with limited capacity to increase supply, the US government decided to pump $1.9 trillion fiscal stimulus funded with debt and money printing by the US central bank, further pumping up an already hot economy at close to full capacity. The major central banks, led by the US Federal Reserve, were too late in their response to this. The usual playbook for reducing inflation in a hot economy is to rise interest rates. The timing of this is crucial. Wait too long and inflation can get out of control, as it starts to change expectations of economic participants. If people start to think inflation will remain high, they will demand higher wages and change spending habits, thus entrenching inflation for longer and creating an inflationary cycle. The best answer to this is for central banks to raise interest rates early. Unfortunately, central banks were late to the party again, led by the Fed, who kept rates at their lowest levels in history through 2021, effectively continuing to stimulate the economy via monetary policy despite the fastest rise in inflation in the US in more than 40 years. This complacent response is now costing us. Overstimulus into a hot economy followed by a slow response from central banks was probably the cause of the 1970s inflation cycle too. Dominion always tries to end these messages with an optimistic note, but sadly in this case, the message is one in which economic mismanagement caused high inflation, with political leaders in the West refusing to take responsibility and instead passing the buck. Hopefully, the belated response from central banks to fight inflation works. We have seen commodity and other input prices come down significantly from high over the past several months, and this may indicate that a decline in inflation is coming soon. But investors should also be prepared for inflation to continue to be a problem for longer than expected, as history shows us that these cycles of inflation can sometimes continue. The trick here is to focus investments into assets where inflation, high or low, is not a major issue for the long-term value of what you're investing in. Dominion continues to think that high-quality, growing businesses trading at reasonable valuations offer a safe harbor for investors to wait out this storm. The sources used on today's video were Yahoo Finance, Bloomberg, and Dominion. My name is Juliana Lato from K&G International Advisors, and we wish you an excellent start of the week. Also, we would like to thank you for watching our video. Don't forget to subscribe to stay updated on all the important financial news, and don't hesitate to contact us if you have any queries or further comments.